So in 11.1, we learned about purchases, returns, and allowance. And in this lesson, we're going to learn about sales returns and allowances. And so credit allowed to a customer for the sale price of returned merchandise is called a sales return. And then when you get credit for either part of that sales price, that's called a sales allowance. And we're going to use a credit memo instead of a debit memo. And so this is really just the other side of what we did in 11.1. So in that lesson, 3 Green, or your company, is the company who's returning merchandise to another business. And this lesson, your company is giving credit to a customer who bought stuff from you that they're returning. So it's really basically just the other side of that same transaction. So the credit memo looks very similar to the debit memo. It's just that it depends on which side of that return you're on. And so it's going to result in a decrease in the amount owed to 3 Green from Lake Automotive in this particular example. So sales is a revenue account. Revenue accounts are equity accounts and have a normal credit balance. So sales returns and allowance excuse me, is a contra account to sales, meaning it contradicts the rule. It is going to decrease sales in the end, and so it has a normal debit balance. It's going to act a lot like our expenses and our drawing accounts. So the transaction says granted credit to Lake Automotive for merchandise returned plus sales tax, because that's important. You got to do that sales tax too. So the sales returns and allowance is going to go up with a debit. Sales tax payable is going to go down with a credit. Now, that sales tax payable is a liability. It's money that we collect when we sell stuff to customers, and we hold it until we have to make that payment to the government. But since they're returning this, we're also going to return their sales tax to them. So that account is going to go down. And then accounts receivable, what they owe us, is also going to go down. So this is a 3-line transaction. Your debit of sales returns and allowance, then your debit of sales tax payable, and then you do your credit. And this is much like in the last transaction. We have to post that amount to the general ledger, accounts receivable, the controlling account in the general ledger. We also have to post it to the customer account in the accounts receivable ledger. So we're going to have that diagonal line there again. Now, when you post this to the accounts receivable ledger, you're going to do your date, your G12, then you take your credit amount and post it here. Now, accounts receivable is an asset, has a normal debit balance. So we have a debit balance here, but we're showing that they owe us a little bit less than they did. So that credit, you subtract and it gives us our new balance. And then you're going to come back and on the bottom half of the diagonal, because Lake Automotive is on the bottom half of this diagonal, you're going to put that customer number. And then just like we showed you in the last journal, you would also post that to the general ledger to accounts receivable. And then the second part of this lesson is talking about correcting errors in a subsidiary ledger account. So it says, found that a sale on account to Skinner College was incorrectly charged to the account of Wells Apartment. So once that's already been posted, you're just going to do that reversing entry or correcting entry, where we're going to take it out of Wells Apartments and put it into Skinner. So again, accounts receivables have a debit balance. So we want to put it into Skinner College with a debit and take it out of Wells Apartment with a credit. Very similar to some of the other correcting entries we've done in the past.